Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Chartworks.com runs down the action on the markets. He talks about how China has changed its reserve ratio and what that means. Wolf Street's Wolf Richter chats about cars, trucks, and real estate. There's a shortage of large trucks and the people who drive them. Could that be the push needed to put robot drivers behind the wheel? Founder of EdSteerGoldandSilver.com, Ed Steer comments on the precious metals market. He believes gold and silver will not just rebound from low prices, but take a giant leap. Plus, at the end of the show, we'll have a company showcase update from American Manganese CEO and President Larry Reaugh. We'll talk with Ross Clark right after this.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, CEO and President and Head Hoopah at chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back after a bit of vacation there, Ross.
Yeah, I went to Canada's only desert in a Soyuz, and it was a nice breather.
If you like 100 degrees or 39-degree temperatures.
Well, it was a nice change from Vancouver. The humidity is just the opposite of Vancouver's humidity. So, but, you know, you go away and the markets take a little bit of a breather and then start to move again. Look at, here we are, not much happened on the dollar index, but the price of gold took it on the nose, got down to just shy of $1,200 this week. On the other side of the coin, you've got the S&P and markets reasonably strong, but there's rotation going on. We've been really bullish on the Russell 2000 there a couple of months ago as it was breaking out, and it got up to target levels, and it's spent now probably 6 to 8 weeks just thrashing around, while some of the other sectors have come to life. So things like the REITs, real estate investment trusts, both sides of the border, Canada and U.S., they're at the best levels now, getting back close to where they were in January. And if you include the distributions that these companies have, the dividends they're paying out, they have just been, over the long pole, one of the best places to be. And over this last number of months, they've been pretty good and just really showing good life right now. Everybody likes to talk about the trillion-dollar company out there right now with Apple, but there's a lot of other good stuff going on as well.
Well, Amazon must be getting close to being a trillion-dollar company as well.
I didn't see the exact numbers, but I think it's in the 800 billion range. Yeah. So you got the second richest person in the world at Amazon.
And Microsoft is hanging into that crowd as well.
Yeah, and that's one that you think about it. Microsoft really, after its boom into 1999, first quarter of 2000, it really took it on the nose until 2009. This stock went from 60 down to 15. It finally broke out again in 2016. Took that long to get back to the old highs at that $55-$60 range, and here we are at 105 right now. So sometimes you get those big long consolidations, and the longer the base, the bigger the rise that you'll get, because there's just so much energy becomes stored up inside those. And if you've got companies that do manage to make the adjustments over time, in the case of Microsoft, moving into the cloud and doing that type of business, which is what Amazon's big at as well, that's where companies are quite different than, say, commodities, where, if something's not working quite well for a company and they've got the right management team, they will make the shifts that are necessary.
China has changed their reserve ratio. What does that mean? Can you maybe explain that to us?
Well, the reserve ratio for the Forex forward market there, they've moved that up to 20%. And what that did, the yuan has been very, very weak since March, and that on Friday created a good reversal in the yuan. Not quite enough to break it out and create what we would look for as a clear breakout of the trend that it's been in, but it's right on the verge of it. If there is any continuation next week on the downside for the yuan, the probability is that you'll see a big correction, and with that, we've been doing some correlation models of currencies against the gold price. And, we all like to look at how gold moves in terms of U.S. dollars. When the dollar is strong, gold tends to be weak. And we'd look at to see how weak is gold relative to the dollar index. It gives us a good indication of things. In this case, the dollar has been pretty steady in a tight range for the better part of 5 or 6 weeks, while gold has taken it on the nose from being in that 1260 to 1270 range all the way down to 1205. However, when we take a look at it against the Chinese yuan, you see that this move that we've had since March, where gold was up at 1360 and has had the break, roughly a 10% break. And if you look at the currency on the Chinese side, its move has been 10.2%. Both of these are back to levels that we saw in the second quarter of 2017. So the moves into March of this year, and then with the recovery since then, has been very, very similar. So in the terms of both markets, they're overextended. The yuan is in need of a good retracement rally. And the gold market, while I was away, I put out a report that 2 weeks ago, the commitment of traders numbers got into extreme territory. And we watch the COT numbers, that's to the commercials and the speculators, to see how big their commitments are. And 90% of the time, they're really in the middle territory. And it's some people try and overanalyze them when they make minor moves. We're more interested in when the extremes happen. And that's what we're seeing right now. You've got the gold commitment of traders numbers on the specs. We're down to 28,000 net contracts long. Silver's 6,000. So these are very small numbers. And if you look at the relative strength of the COT numbers, and you look at the Bollinger Band on them, they are at extremes in terms of being outside of the Bollinger Band and overbought or oversold as far as the relative strength is concerned. This puts us in a position where any change in the fundamentals, any catalyst that then turns the price through its resistance level, and in gold that would be at, say, the close of 1232 would be a very definitive reversal. From there, we should see a very, very smart bounce and rally to the upside. Also, if we look at the daily sentiment numbers, we've been down around 12 to 15% bulls in gold for the better part of the last 10 days. So we just don't have many people out there who are bullish on the product right now. Whether this is a final low or whether it's just becomes a corrective rally, that we'll find out down the road. But right now, we're set for what could be a reasonable move. The confirmation for gold will be that if you see the yuan and the dollar, U.S. dollar, move down through 670, while gold is moving through 1232, you're going to have a really strong conviction on that trade.
And we'll be talking more about gold and silver with Ed Steer later in the show. And a reminder, we'll also be talking cars, trucks, and real estate with Wolf Richter right after we finish our conversation with Ross. And Ross, thank you so much for being on This Week in Money.
And it's nice to be back again.
My guest has been Ross Clark from chartsandmarkets.com. Stand by. We'll be back right after this.
Always consult your investment professional before making any investment decision.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Wolf Richter. He's the founder of wolfstreet.com. He's speaking to us from San Francisco. Wolf, welcome back to This Week in Money.
Thanks for having me back, Jim.
Wolf, what do the earnings warnings of the big three U.S. automakers mean for the global auto industry?
We had one day that we haven't had in many years. That was the day when all three Detroit automakers suddenly together gave earnings warnings about their global businesses. So there were different aspects to it, but it all came in one day. And we haven't had that kind of back-to-back bad news story since the Great Recession. So this was pretty significant, and their shares got just crushed when this happened. GM, they warned about, all three of them warned about rising commodity prices, particularly steel and aluminum, but a lot of things are getting more expensive for them, so there are cost issues, and they all three warned about them. GM warned, and GM already got rid of its European unit, Opel, so it can't complain about it anymore. That always used to show up in earnings warnings. But that's gone now, and Opel is being profitably operated by a French company, so they no longer can blame that. But now they're blaming currency issues in Brazil and Argentina. You know, the Argentine peso totally collapsed in the second quarter, and that causes some issues. They're blaming North America, where that's mainly the U.S. and Canada, where their operating profits plunged 23%, and so that's the most profitable part of the business, and that could be due to incentives and the cost of trying to get the units out. All three Detroit automakers peak in terms of deliveries in the United States in 2015, and they started losing ground a little bit in 2016, even though the foreign automakers still gained ground. So in the United States, in terms of deliveries, 2016 was still a record year, but not for the Detroit automakers. And then 2017, sales declined for the whole industry, including the big three. And in 2017, it looks like maybe a slight decline so far from 2017. So in North America, the market really peaked, and it's not plunging, but it's tapering off gradually in terms of deliveries. And the big three automakers have in the past gotten around that by raising prices, and they've raised the prices dramatically, and then where needed, they tried to throw a lot of incentives at it to make the units move, but the sticker prices have jumped by quite a bit, and so that has helped them. Now this year, operating profit in GM in North America, that's a real issue. It's down 23% in the second quarter. When the profits in North America don't come in, then GM is going to have a hard time. Now Chrysler complained about the same thing, rising commodity prices, but then it really complained about China. And GM is one of the top automakers in China, and GM sells more cars in China than it does in the United States. Chrysler is not on that level. So Chrysler's having a hard time in China, and they're trying to fix this, and it's not particularly working, so they addressed that in their earnings call. China is, with 24 million units sold a year, is by far the largest market. That's where everybody wants to play, and when this market doesn't work, it's a big deal. In China, obviously, foreign automakers have to manufacture with a joint venture, usually a government-owned Chinese entity. So that requires technology transfers and other things. So they don't get 100% of the sales credit since there are other joint ventures involved. And depending on how good or how bad the joint ventures are, that has a lot of impact on how they're doing in China. Ford's got a new guy running it. He came in earlier this year, and one of the things he did back then in April was announce a $25 billion restructuring program going out for 5 years or so. And part of the program was for Ford to stop selling cars in the United States except for the Mustang. It was going to switch to crossovers and SUVs entirely, and the only car proper that it would sell in the United States would be the Mustang. The whole thing will cost $25 billion. And so during the earnings call this time around, the new guy, Hackett is his name, he threw out another restructuring program of $11 billion that's going to drag out for 3 to 5 years. And now nobody knows anymore which is which, whether this is on top of or part of the prior restructuring program. If it's on top of, it's $36 billion in restructuring expenses. I mean, this is a huge amount. There's so much unclarity and fog about where Ford is going with this. That Ford their shares traded down when this came out to lows not seen since 2012. Investors are really worried about this. Now, Ford also blamed the prices of steel and aluminum. It had a supplier whose factory caught fire, and that supplied parts to Ford's most profitable product, the F-Series pickups. So production stalled there for a while in the quarter. So Ford blamed that. Then Ford blamed China big time. Now, China is not a new problem for Ford. In terms of unit sales in China, Ford peaked in 2015. And I did the math on that, and it's just astounding. In the first half of 2015, Ford, through its joint ventures, sold 528,000 vehicles, and that was its peak. During the first half in 2018, it sold 231,000 vehicles. So that's down by 56%. So when your sales collapse by 56% over a period of 3 years, you have a very serious problem. And every year Ford tries to say, yeah, we're changing products, we're doing this, we're doing that. And every year it just gets worse and worse and worse. So, and that's the largest market in the world. That's a market that was booming during that period. So Ford lost 56% in sales, during those 3 years. At the same time, the market itself is very, very strong in China. There's no excuse for that. And Ford lost close to $500 million in China during that time, during the quarter. So, I mean, they're really struggling to get China put together, but they just don't have the formula for that.
Could you see in these tariff wars going on between the U.S. and China, the Chinese government making it more difficult for U.S. automakers?
Well, Ford has lost sales in China since its peak in 2015. So Ford's China woes are not really the result of that. The tariffs just kicked in, and they didn't even kick in the first part of the second quarter. That kicked in much later. So, that's a forward-looking issue. That's an issue that might impact them down the road. The current woes are not necessarily impacted by that, and China's Ford sales in China are independent of that. Now, looking forward, so the guidance they gave, they're figuring that steel and aluminum will cost more, and And that's true. Tariffs are a tax on importers, and they're supposed to be. They're sin tax. They're a tax that impact profit margins. And, the American companies just got a huge, tax cut. So the tariffs would, be a very small, tax increase, in effect. So, they're still coming out ahead. Nobody complained about the huge tax cuts they got. I mean, the shares jumped and everybody was really happy about that. So now they're getting a little bit of a tax increase on some of their imports and they're wailing and gnashing their teeth. And, it's just the auto industry. Their margins are going to they're going to come down a little bit. And, they probably cannot pass on these higher expenses to consumers because consumers are on strike. They have to, already manufacturers have to put rebates, on their cars to sell them. If they raise prices, they can't sell them. So there's many manufacturers that make models in the United States, including foreign brands such as Honda and Toyota. And Honda is probably, some of the cars that Honda builds are the most American cars around. And they're not impacted by tariffs. They're not raising their prices. So prices are determined by competitive environments, the tariffs are going to squeeze margins a little bit, just like the tax cuts improved the profitability. And so it may have some impact going forward, but it should be relatively minor. Now, Ford also complained about Europe. So in the second quarter, it lost $23 million in Europe. Europe has been pretty strong. That has nothing to do with tariffs. These are problems that are inherent in the company, and the thing with tariffs is that corporate America just hates it, and they hate any kind of tax increase, and they love any kind of tax cut. So they got a huge tax cut now; they get a little bit of a tax increase, and they hate it. So they make sure that every politician in the world knows that these tariffs are going to be the end of the world. And, so there's a huge pressure from all elements in corporate America, on the White House to do something about these tariffs, just like, there was huge pressure in corporate America to produce these tax cuts. And they got the tax cuts and now they're getting a little bit of the tariffs. So it's really, they're exaggerating. It's not such a huge deal. They're going to lose a little bit on their margins, but their sales aren't going to collapse in China and Europe because of that, so. And that is for other reasons when these problems happen. Now, each company, GM, Ford, Fiat Chrysler, they all had different problems, and at the same time. So looking forward, they cut the guidance quite dramatically, but for different reasons. So the tariffs were just one minor item in it, but the sales problems. Many markets have peaked. In the United States, for example, Canada too. Canada vehicle sales through July are down slightly from the same period last year. So there's this peaking process going on. South America is in trouble because of the strong dollar has caused a liquidity outflow. Some of the currencies got hit really hard. And that's a fairly good market for the American manufacturers. They don't really play a role in Japan, so that market is sort of off limits to them. So some of the biggest markets have peaked, and that's one of the big problems they're facing. They've had it very good for 5-6 years. Since the Great Recession ended, the market started peaking in North America in 2015, 2016, and it's now peaking in other countries. So this is sort of going around. The business is very cyclical, and people buy cars, they replace what they have, and then suddenly, they realize they don't need to buy anymore for a while, and they pull back. And we've had these cycles, and we continue to have these cycles. So it seems like in the United States and in other countries too, the cycle has turned. And that's what they're seeing, that's what they've warned about. We're not really seeing that in the numbers yet. in terms of vehicle deliveries, but that's kind of what they're looking at from their point of view. And that's why this is so worrisome, because we haven't heard that kind of story in so many years. We've forgotten what that sounds like, these kind of earnings warnings from the Detroit automakers, coming out all at once together, about the future, about rising costs, about, losses, about declining sales. I mean, this is not something, we've heard recently. So this is a concern. Now, Tesla doesn't really fit into this. Tesla doesn't really, in terms of sales, Tesla doesn't really matter. It's selling its vehicles globally, but in the quarter, it delivered a little over 40,000 vehicles. That's 0.2% of the global deliveries of all automakers. So its market share globally in the second quarter was 0.2%. It's minuscule. So when you talk about 20 million units sold in that quarter, Tesla doesn't even fit in. It's not even a rounding area. It doesn't even show up. Why we always talk about Tesla remains a mystery, except for its enormous stock price. So Tesla, stays in the media. And it reported earnings yesterday. Earnings is the wrong word, because it reported its largest loss ever. It reported $718 million loss. So sales were up 40% from a year ago, and its loss was up over 100%. So the more it sells, the more it loses, and it's trying to ramp up production of its Model 3. So that's what you're seeing in the sales increases. At the same time, its costs are just skyrocketing, and they're doing it faster than the sales increases. So, Tesla is not a startup company. It's been around over 10 years. It's lost money every single year of its existence, and the losses are increasing every year, and as its sales are increasing. So if you after 10 years, if you look down the tunnel and, your sales are increasing, but your losses are increasing much faster than your sales, what you see at the end of the tunnel is not the end of the tunnel. That light that you see there, that's the locomotive coming at you. And unless Tesla changes that, it's going to have a huge problem. Now, one thing that when I looked at its filings with the SEC, I noticed is that in the second quarter, it claimed to have produced, quote unquote, a little over 53,000 vehicles, including 18,000 Model 3s, but it only delivered a little over 40,000 vehicles. So there's 12,500 vehicles that it said it produced, but it didn't deliver. And in the second quarter, something similar played out. It's 4,500 vehicles that it said it produced, but it didn't deliver. So combined now, we're looking at 17,000 vehicles, mostly Model 3s, that Tesla said it produced, but it didn't deliver. And this confirms the veracity of the many videos and photos that are circulating on the internet of these huge parking lots full of brand new Model 3s. There's all kinds of rumors why this is happening, that they're unfinished, that they're missing parts, that they need to be tested, and that some of them may be damaged or, they may be flawed and may have to be redone. 17,000 units, Model 3 cars, when you think about the total production in the second quarter of 18,000, that's a huge number. In other words, Tesla is making Model 3s, but it can't sell them. It's sitting on them. It's sitting on the majority of the Model 3s that it's producing. And so when it claimed that it made 5,000 units in 1 week, it used the phrase, quote unquote, factory gated. So it got them out of the factory gate. And that's where it parked them. They weren't ready. They weren't finished. They weren't saleable. So it parked them outside the gate and claimed it produced 5,000 vehicles, but they're sitting there. That's 800 at an average price of $50,000 per vehicle. That's $850 million that's sitting there. And it shows what huge problems Tesla has, not only in manufacturing, but also in getting these units to the buyer. There's buyers out there, apparently still. And so Tesla is sitting on 17,000 Model 3s in parking lots. They're not going anywhere. So this is a huge problem for Tesla. I mean, Tesla's, the cars may be okay and may be good. People like them. The Model 3 may have some quality issues due to the push to manufacture, so many so quickly. And there are big service problems in trying to get parts and getting, when you have a collision with a Tesla, it's very difficult to get parts. There are long waits involved and those kinds of issues. But the design of the cars, people are not complaining about that. They're good. They're nice looking cars, very nice looking cars. And electric vehicles, if you like to drive one, they're great. And but in terms of a manufacturer, Tesla is just incompetent. And at the same time, it has this gigantic stock price, that $50 billion market cap, when it can't make money, when it's losing more and more money, when it can't mass produce anything. It's a niche manufacturer, and it did pretty well, making small batches of vehicles. Now it's trying to be a mass manufacturer, and that whole concept is just not happening for Tesla. So, but that's a different issue. The three big Detroit automakers, they face their own global issues. What Tesla is facing is itself. It is just an incompetent automaker. It has a good design shop. It has a great marketing shop, but in terms of actually manufacturing the things, mass producing it's just incompetent. And and I warn people, don't short their stock because it's idiotically overpriced. Something that is this irrational. There's no rational limit for it by definition. So it can go, as it did today, it can jump, for the wrong reasons. And so, this is not a stock that it's the most obvious short in the world, but, because it's the most obvious short, it's also the most dangerous. And, I've been on record for years to tell people not to short this thing.
Wolf, could you see Tesla contracting out its construction at some point because they're so bad at it?
Yeah, a lot of people said that. I should just let the Chinese build the cars. And, but then what's left for Tesla is just a design shop. And what would be its market cap if it's just designing cars and then somebody else is building them? And when the Chinese are building it, they're going to build a second factory next door that's going to build the same car under their own name. For a lot less. And, when that's happening, Tesla would lose every little bit of what's part of Tesla now. And, a design shop cannot be worth $50 billion. That just can't happen. So, but in many ways people say, let the Chinese manufacture those cars, but it just wouldn't be a Tesla anymore, and these Chinese-made Teslas would compete with, Chinese cars that look like Teslas and would be essentially the same and would be a lot cheaper. So I don't know, if Tesla gets into serious trouble, that may be one of the options it's going to look at. And, Tesla announced today that it's trying to fund the $5 billion factory in China, and that could be one of those steps in that direction. If it finds Chinese investors to lend it that money to build a Chinese factory and run by a Chinese joint venture or something, maybe its manufacturing problems could be resolved. But I doubt that American buyers would appreciate driving a Chinese-made Tesla.
We'll be talking real estate when we return with Wolf Richter next on This Week in Money.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason. President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Riaugh shear zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're chatting with Wolf Richter. Wolf, are there comparisons between the cities in Canada and the U.S. with the biggest real estate bubbles?
Yeah, there sure are, and there are very big differences too, and especially how the federal and local governments are dealing with it. In the United States, the biggest bubble is probably in San Francisco, and in Canada, the biggest bubble is probably in Vancouver. And in Vancouver, sales are down about 30% year over year. The market, the supply on the market has jumped over 30%. So active listings are up over 30%. Sales are down 30%. So there's a lot of supply. There's not a lot of demand. Prices are still there. They're still hanging in there. Detached home prices they're slightly down year over year. Condo prices are up. So price changes really haven't kicked in yet, even though demand is flagging. In San Francisco, condos had been flatlining since 2015 until suddenly we got this huge spurt earlier this year. So in terms of US dollars, the median price of a condo right now is about $1.2 million. And houses have been booming for the last couple of years. And the median house price, a detached house price, is $1.6 million right now. So that is far higher than the prices in Vancouver. At the same time, the Canadian government came out with a bunch of measures to tamp down on the housing bubbles, and the government of British Columbia started doing that in 2016 with its foreign buyer tax, and had a bunch of other measures since then, including most recently some disclosure requirements when condo flippers are buying condos, pre-construction condos from developers only to flip them. And there were some tax implications. You didn't have to declare this, so you could get away with it. And so now there's all kinds of policy changes being undertaken. There's stress tests at the federal level and other things. So many little moves have been made but they combine, to tamp down on the housing bubble. The same thing has been done in Australia. In Australia now, in Sydney and Melbourne, after those so-called macroprudential policy changes were put in place, home prices are skidding now, and then they're down 5% in Sydney year over year. They're down about 3% in 2% in Melbourne. They're down in other parts. So these policy changes have an impact. The price changes haven't really kicked in that much in Vancouver yet, though. We've seen increases drop, or for detached houses, they actually fell a little bit. But it shut off the volume. And that's the first sign. When the volume drops, you have sort of a disconnect between the seller and the buyer. The buyer wants a high price. The seller wants a high price, and the buyer refuses to pay it. And so volume drops. And until either buyers give in or sellers give in, you don't have a sale. And that's kind of what's happening right now in Vancouver. People are still thinking they're going to get these high prices, and they put the units on the market, and some of them are just not selling, and they have to pull them and put them back on the market at a reduced price for that sale to happen. And so that's when you have a declining volume situation that usually precedes declining prices by some time. Now in San Francisco, even though we've had a much bigger bubble here than you guys in Vancouver, nobody is even thinking about doing anything about it. This is a bubble driven by all the same dynamics as in Vancouver. So you have a lot of foreign investors coming in. You also have high-tech companies that are hiring fairly strongly. And so there's quite a bit of demand. But the prices are ludicrous. So even if a household makes $250,000 a year, a median, detached home costs $1.6 million. So even then, this median means that it's not big, it's not a palace. It's just a little bitty house, out in the avenue someplace in the foggy area of San Francisco, and, it's not the most convenient located, and, it's median. So it's right there. And it's nice, but, it's just median. A median condo for $1.2 million, that's likely a 2-bedroom. It may or may not have a garage, and it's not in an expensive building. And if it's a 2-bedroom, if it's a 1-bedroom, it can be in an expensive building. These are not really, big places. They're small, they got 800 square feet, 700 square feet, that kind of thing. And, there is something we call the housing crisis in San Francisco. It's not that we don't have any supply. There's plenty of supply. What we don't have here is affordable supply. And so it's a crisis of affordability. And it's been called housing crisis for years. And there's some local efforts to address it, but not to address the house prices, but to create subsidized housing. That's how they want to locally address it. And that's not a solution. That doesn't help tamp down on the housing bubble here. Whereas in Canada, and it's not just Vancouver, but in other cities too. They're trying to keep the housing bubble from completely going out of whack. And housing bubbles are very dangerous. People are very excited about them on the way up. Governments like them because property taxes are throwing off more and more revenues. So generally local governments just love housing bubbles. They create quite a bit of local business because you'll get a construction boom with them. So there's local workers, local materials, these workers have to buy lunch and buy trucks, and so it stimulates the economy quite a bit. But they put lenders at risk. And housing bubbles are not sustainable. They never are, and they never will be. So at some point, they're going to deflate. And when housing bubbles deflate, it puts lenders at risk. And that's happened in every market, And in Canada, the banking system is very concentrated. And so the bank regulators are very concerned about the risk that these banks expose themselves to with these housing bubbles. And so they're understandably trying to keep that from getting worse. And, in the United States, there's no effort made at all. It's just let it go. And, the Fed has been raising rates in the United States, but not aggressively. So this year we're probably looking at 4, rate hikes of a 1/4 point each. So that's 1 percentage point. Last year there were 3 rate hikes, so a 3/4 percentage point. We had, a rate hike the December before and then one a year earlier. So it moves very slowly. Our rate hike cycle normally lasts 2.5 years, and the Fed tends to bump up rates by 4 or 5 percentage points during a cycle. Now we're 2.5 years, more than 2.5 years into it, and, the Fed has raised, a couple of percentage points. And so it's very slow. And it hasn't really impacted housing yet. House prices are still going up in most markets. And, there's some exceptions, but, mostly going up. And so that's the only effort being made. Now the Fed has mentioned, commercial real estate and residential real estate as a potential problem area in terms of asset price inflation, along with some other things. So they're keeping their eye on this. But on a, government level, so, away from a central bank level, there have been no efforts made to tamp down on the bubble here. So that's, I think, is the big difference. We're impacted by similar dynamics in Vancouver and San Francisco. The employment situation is a little different in San Francisco because we really had a high tech boom. And you've had some of that in Vancouver too, but it's just been really big in San Francisco. And at the same time, the BC government and Vancouver are trying to address this, and they have been for a couple of years now, and in various targeted ways, more or less successfully. The jury's still out, and people are complaining, because anytime you try to tamp down on a housing bubble, the people that are vested in it, they don't like it. But a housing bubble, what it does, it removes the possibility of buying a home for many people. Yeah, the incomes aren't coming up fast enough, and so you're really dispossessing a group of the population for the benefit of asset holders. And rents are going up in tandem oftentimes, so it makes rent payments very expensive. You have an economy that shifts more and more to housing because that's how everybody has to spend more and more of their money in terms of rent and mortgage payments. There's not enough money left over for other things. So it shifts the economy around and it takes money away from other sectors of the economy and pushes it all into housing and finance. And that's not a very healthy thing. That's a very one-sided end of the economy. And that's why housing bubbles are really, overall they look pretty good on the economy until they turn. But in terms of how the economic activity is distributed, it takes it from one place and moves it to another, and it takes it from more or less the real economy to the finance economy, and because more and more money gets put into interest payments, into mortgage payments, and the like. So once the construction boom is real economy, and it's very strong, and that's good. And construction booms are ultimately the solution to a housing bubble. If you create oversupply, it will eventually bring prices down. And so construction booms should be lauded. They're cyclical and they go away, but they're really the solution to the ultimate solution to a housing bubble. And let there be oversupply. And of course, that's when people start fretting too, because they don't want housing to collapse. At the same time, that's really the final solution to a housing bubble, is you have to create more supply than there's demand, and that will take care of it. And that's happening. That's happening in all along the West Coast. There's construction booms coming from Southern California all the way into Canada, and so supply is being created. So that part, it may be the wrong supply. It's all high-end supply. It's where the money is. So everybody's trying to create high-end condos and apartments, but it is supply, and it will put pressure on prices and rents.
We'll have more with Wolf Richter, and we'll be talking trucking when we return.
Vadic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vadic's management has extensive potash exploration and development experience in Thailand. Vadic will have marketing advantage compared to Western producers. Drill program commences this spring. Vadic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vadicventures.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter. Wolf, what kind of trends do you see in the trucking industry?
Right now, everything is up. And trucking, we're talking about heavy trucks that pull loads across the highways in North America. And the industry went through a recession in 2015 and 2016. And the trucking industry is it's very cyclical, but it's also a thermometer in the goods producing economy, not the service economy, but the goods producing economy. And in the United States and in North America more generally, the goods producing economy went into a tailspin in 2015 and 2016, in part because of the collapse of the energy prices, but also for other things. And the service economy hung in there, But, inventories were high going into it, so companies started reducing inventories by ordering less. So it required less shipping. The supply chain thinned out a little bit. So you had this period of about 16, 18 months in 2015 through 2016, where every metric in the trucking business, in the railroad business too, was negative. So, the freight rates went way down, the tonnage, dropped, the shipments, the total number of shipments dropped, everything just fell and fell dramatically. There were layoffs in the industry. The truck manufacturers, saw their orders stall, so they laid a bunch of people off. So this was, that was one, the cycle, and it was very tough on the industry. Then starting in 2017, suddenly the boom starts, and now it's a historic boom, all the way around. In terms of, shipment volume, we're up about, close to 10% from a year ago in the United States. In terms of, pricing, we're up a lot more. So, the United States, shippers, spend about 12% more year over year, recently, on freight. They're doing it because, diesel prices are up, but even freight rates without fuel surcharges are up. So everything is increasing. There's a huge amount of demand. Truck makers, they're all complaining that the supply chains can't react fast enough to the orders, so they're sitting on a record number of orders, 400,000 truck orders right now. And, they have trouble producing them, so there's a huge backlog. Shippers, so companies that are in the consumer goods business or in the industrial business, they're complaining that they can't get the merchandise shipped to their customers. And, retailers are complaining, everything is trying to switch to the internet, to e-commerce. And e-commerce has a very big brick and mortar component. That's, the warehousing part and the trucking part. And, warehouses have been booming. So it takes trucks to deliver that stuff. So there's an enormous amount of demand out there right now and limited supply. There's a number of reasons why supply is limited. Number one, we came out of that transportation recession. So, during that time, capacity had been cut. So now they're trying to expand capacity, but it's happening all of a sudden, and you can't do that. So it takes a while to build a truck, and the order banks are full, and they're building them as fast as they can. So by the time, it's very cyclical. By the time they get those trucks out, probably demand is starting to flag, and they'll sit on overcapacity, and prices drop, and the shipping volumes will drop, and we'll get back into a transportation recession. But that's off still a little bit. So right now we're in the boom time. And this includes, flatbed trailers. The industrial economy, that's a measure of the industrial economy. They're hauling heavy equipment for manufacturers, for the oil field, for other industrial, for construction. And the industrial economy in North America has been fairly strong, and trucks are delivering that merchandise. So it's spread around. It's the consumer economy, the industrial economy, it's energy, and what we have today is shippers complaining that they can't get the stuff. We have trucking companies in hog heaven because they're raising freight rates, and they're having all the demand they can possibly fill. They're griping about not being able to hire enough drivers, and they're griping because the trucks they order take too long for them to get. But other than that, they're happy. Their profit margins are huge. They're reporting strong earnings, and they're keeping everybody busy. And railroads are happy too. They're picking up heavy loads. The intermodal business, so that's the business that uses trucks and railroads, either through containers that are offloaded from a truck to the railroad, or by piggybacking trailers on railroads, railroad cars to ship them across the country that way. I mean, that's a big part of the freight picture, and that is booming too. So in every end of the transportation business, it is right now running at capacity. there are not enough drivers, there's not enough equipment, and it is very difficult to for shippers to get stuff delivered on time. And given how cyclical this business is, I'm looking at the charts right now. It looks like we may be approaching a peak here pretty soon, but it will be a long time before it actually tapers off. So I would think, maybe by later this year we'll have the first signs that the cycle is over. But right now it's just capacity limitations, shortage of drivers, shortage of trucks, high prices, shippers complaining. Inflationary pressures are building up big time. These are high freight rates. They're making themselves into product pricing. So that's one of the pressures that the United States faces in terms of inflation building up, and that part will probably get worse as we go further into the year, and fuel prices are likely to rise a little more. This is a boom that directly impacts wholesale inflation and indirectly, in fact, impacts retail inflation as the prices filter through. And, it's an amazing thing to watch, how cyclical it is, how bad the transportation recessions are, and how good and how big the booms are.
Wolf, with rising fuel prices and a shortage of drivers, could this really be the big push needed to get robot-driven electric trucks out there?
Well, there's certainly some people trying to produce them. Now, Uber just shut down its self-driving truck enterprise. It bought Otto for an ungodly sum, and they were building self-driving trucks, trying to. And then there's some publicity stunt with a truck delivering beer. And but it's very difficult, and it's a very difficult business. And Uber is strung out, and it needs to eventually make some money. It wants to run an IPO, and it can't be wasting money on this stuff. So it pulled out. That's gone. But the big truck makers, so Mercedes and those companies, they're all working on this technology. We're not anywhere near for this technology to be mature enough to deal with the cyclical nature of the trucking business that we have right now. So this will eventually happen, but it's years away, and before we get there will be several more cycles in the trucking business. So this will not promise any kind of relief. Now, many of the innovations in the self-driving technologies are already on trucks. They're being used to enhance safety and other things. So there's this standard now, and they're not driving themselves, but they have functionality that is part of self-driving trucks, and they can avoid stop before obstacles and do all kinds of other things that are very important. But in terms of pure self-driving trucks, we're years away, and the public is really leery. Self-driving cars, that's worrisome enough for the public. But a self-driving truck barreling down the highway at 75 miles an hour, and then the Windows operating system shutting down, and the truck going haywire at that speed, and nobody there to control it. I mean, that's unlikely to happen, but that's what people imagine. So these things have to be very good, and they have to be. The goal is for them to be better than human drivers. Human drivers are pretty lousy. But given that we have 36,000 traffic deaths every year, human drivers are pretty bad. So algorithms have to be better than that, but they have to be a lot better than that, because every time somebody gets killed by a self-driving vehicle, it stops the presses everywhere. We get hundreds of people killed every day in the United States. Nobody pays any attention, but this is regular traffic accidents. But when a self-driving vehicle kills a pedestrian or somebody, then this becomes global news. So the standards are different. For these self-driving vehicles to be accepted, they have to be very, very good. And there will always be some accidents. You can't avoid that. But they have to be substantially better than human drivers. And they have to do so reliably and under all conditions. And, they have to be protected from hackers. And so there's a lot of issues to be resolved. So I don't think self-driving trucks will solve our near-term cyclical issues that we have in the trucking business.
Wolf, how can people find out more about Wolf Street?
You can come to wolfstreet.com, and everything is free. We have a vibrant comment section and well-behaved, and we only focus on business, finance, and the economy.
Wolf, thanks a lot for being on This Week in Money.
Thank you.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. Coming up, Ed Steer next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol AESDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Ed Steer, founder of EdSteerGoldandSilver.com and a director of GATA, the Gold Antitrust Action Committee. He's speaking to us from Edmonton. Ed, welcome back to This Week in Money.
Oh, thank you for having me back, and greetings to you and to your listeners as well.
Ed, is gold looking like it wants to move higher or lower?
Well, for all intents and purposes, we've most likely seen the lows for this move down. I was somewhat surprised in early London trading when they had a little tick down to a new low that they didn't drive it even further than that, because we were only, $3 or $4 or $5 away from the lows we had about 10 days ago. And the same applies to silver. So I was kind of expecting on the jobs numbers and for them to hammer it lower, but they didn't. But, we may see lower prices from here, but the trend after that is definitely up, and I would think, seeing what we're seeing in the COT report, what Ted Butler's seeing there, that there's no question about it. The next move from here is up, and I think it's going to be a substantial move.
How are gold miners holding on right now?
Well, by the hair of their chins, I can tell you that. Most miners right now are, some of them are making decent money. If they're all in costs, they're fine. But there's no question about it. They are not making very much money at all. And depending what country you're in and what your costs are, whether denominated in dollars or the local currencies, and what you're getting for your gold price internationally, some are doing okay, and some are doing, well, actually, let's face it, some of them are losing money, especially the South African miners right now, despite what the rand's doing.
Is the silver chart pretty much in sync with the gold chart?
Very much so. JP Morgan and the other commercial traders are making sure that pretty much all the precious metals, and plus copper, of course, all trend in the same direction at the same time. You can just take a look at the charts for the last 6 months and know that there's nothing supply-demand oriented about the pictures they're painting. They're all moving from the upper left to the lower right as they take them all down in sync with each other. There's the odd one that's like platinum moved up in the last 3 or 4 days, and palladium's off its lows by a bit, but gold and silver have been in lockstep heading for the basement, and they're going to keep it that way until they decide they're going to let prices rise, and then we'll see if market forces take over or not at that point.
China right now has a surplus of solar generating equipment, and of course that involves a lot of silver. Would that affect the silver market if it was really driven by demand and use rather than manipulation?
Oh, sure, absolutely. I mean, supply-demand fundamentals have never been in place in precious metals. I'm 70 years old. I'll be 70 on my next birthday. And there has never been a free market in the precious metals in my entire lifetime, and next time it is will be the first time. And whether China's using the more or less silver or whether more or less is being produced by the mines in the world doesn't really matter when the prices are controlled in the COMEX futures market in New York.
How does the sentiment look for gold and silver?
Right now, you really want to know, Jim, it sucks big time. people right now are down in the dumps, and this is the worst of times for people who are invested. I mean, I have a large sum invested in the precious metals. I'm all in, as a matter of fact. Every cent I own is in the precious metal sector, and for my wife and my kids. And there's lots of listeners out there that have large chunks of their portfolio invested in this, have for years. But one thing I can tell you is that I don't know who the investor said you should be buying while blood is burning in the streets. And when investment sentiment is this bad, this is when you should be laying your money down. I bought some, I increased the position in one of my junior silver mining companies, I don't know, about 4 or 5 weeks ago. Too soon, of course. But this is the time to invest. But I can tell all our downcast listeners, including myself, who's not very happy with things the way they're going, that this will change. And when it does change, it will change in a hurry.
So many people are predicting the markets are going to have some kind of major correction this fall. Is that a good time to hold gold, or should you hold off?
Well, I'll tell you what, it all depends on what's happening in the COMEX futures market, because it doesn't matter what the stock market's doing, the dollar index is doing, or the currencies are doing, because the price is managed by the big commercial traders trading against the managed money traders. And so the external forces may or may not be important, but what drives the market is outside the realm of the stock market. Sure, they may get hit initially, but the fact of the matter is that if the boys decide to stand back and put their hands in their pockets, prices of precious metals and copper and everything else is going to rise too, regardless of what the stock markets and the currency markets are doing.
The Russians just sold off most of their American debt. Was their plan to buy more gold?
Well, I'll tell you what, somebody else asked me that question, and one of my readers, and my answer to them was very simple. If they took all the money they sold in U.S. Treasuries, which is what, I don't know, 80 billion, 70 billion, it's a lot of money. I figured it out. It would be, they would be able to buy 6 months of world gold production with that kind of money. Now, that's just not going to happen. Right now, they're adding about 200 plus tons of gold to their reserves. And it would really be peachy keen, and we'd all love it if they go out there and tell the world, look, well, we're going to take our euros and pounds or whatever else they got, currencies they got them in now, and we're going to buy all our gold, silver, and platinum and palladium production for the next 5 years until J.P. Morgan and the boys get off the price in the COMEX futures market. That would be different, but I don't think they're going to change their buying patterns because they got all this money sitting around, because they'll keep it in foreign reserves, because that's the way the central bank wants to do things.
China, of course, over the last 6 years has been buying all the gold they can lay their hands on. Are they continuing that pattern?
Certainly they are. I would be very surprised if they aren't. If you take a look at what's coming out of the Shanghai Gold Exchange on a monthly basis, I think they're over 1,000 tons already for the first 6 months of this year. So, without doubt, they're going to come very close to another record withdrawals in gold, 2,100 tons. They haven't announced anything recently about how much they've got, but I would think it's somewhere in excess of. I'd be amazed if it's under 6,000 tons they've got accumulated right now. And they'll announce it to the world when they think it suits them, but China's going to keep right on trucking buying gold as long as the price stays where it is right now.
Do you see them someday connecting the yuan to the price of gold?
I don't know, and nobody else does either. The thing that I'm watching is this yuan conversion for oil, or oil for gold, or whatever the heck this contract is. Nobody has gone into there and said, okay, fine, you owe me $150 million or $2.2 billion worth of oil. I want half of that in gold bullion. Of course, the moment that happens, what the Chinese will do is they'll go into the COMEX futures market and put that trade on, and of course then all bets will be off. We're going to see a gold price that you can't possibly imagine. But that hasn't been tried yet, and that's the thing that I'm looking for, whether or not they allow conversion of yuan for gold. I find it highly unlikely at the moment.
We'll have more with Ed Steer next on This Week in Money.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Ed Steer. Ed, are gold and silver following their usual seasonality patterns?
Well, everybody says there's a seasonality pattern. If you look back at the charts over the last 10, 20, 30 years, yes, there is definitely a seasonality pattern to precious metals. But once again, I'm going to stand up and say, look, the seasonality is only there because of the fact that the prices are managed in the COMEX futures market. And that's what determines the seasonality, not whether the supply-demand fundamentals are what they are. We would need to see a free market in precious metals to know if there's any real seasonality out there. But right now, yes, it is following seasonal patterns just like it has in the past. And when that seasonal pattern comes to an end, like I said before, I think we're going to see astonishingly higher prices.
How are the latest commitment of traders' numbers looking for gold and silver?
Well, let's see. Wildly bullish would hardly begin to describe it. I know Ted Butler, Silver analyst Ted Butler, follows these numbers religiously, and I'm on the phone to him every week. As a matter of fact, with the next half hour, I'll be on the phone to him talking about this week's COT report. And his work in this is what I follow very closely. And we've never been in a setup where we are today where gold, silver, platinum, palladium, copper, and in some respects crude oil are set up on a launch pad for a rally of biblical proportions if the powers that be choose that to happen. This week's Commitment of Traders report won't show much, but we're locked and loaded for big moves to the upside, and the COT report certainly confirms that. And the other thing it confirms, and this is through Ted's work, is that J.P. Morgan has been heading for the exits big time in gold and also in silver as well in the COMEX futures market. And they aren't going to get hurt at all when this thing blows up because they got enough physical gold and silver set aside that they're going to make out like bandits when this thing finally does go.
Are you bullish on the U.S. dollar?
I'll tell you what, the U.S. dollar, as far as I'm concerned, is just like any other fiat currency out there. I watch it very carefully because I write my column every day, and I write a fair amount on what's happening in the currency markets. And it's my opinion that the dollar index rally you're seeing right now is just about as manufactured as all the other indexes out there. And if it was allowed to trade freely, heaven only knows what its true value would be, but it wouldn't be what it is today.
Ed, we hear interest rates are likely to continue to move higher. Should gold and silver be reacting to rising interest rates?
Well, interest rates are rising very, very incrementally, and it would take a fairly major move in interest rates before it would even begin to affect what's happening in the precious metals. You know, that's an old canard that's been around for a long time, and I hate to sound like a broken record on this, but the fact of the matter is that what's happening in the currency markets, the stock markets, the bond markets doesn't make any difference. Ground zero in the prices of commodities, especially the four precious metals and crude oil and copper, are determined by J.P. Morgan Chase and a few other bullion banks in New York. And regardless of whether interest rates are going up and down, until they decide that things are going to change, I don't care what the currencies are doing, including the U.S. dollar and including what interest rates are doing.
Do we have too many former Goldman Sachs, J.P. Morgan people in central banks and controlling policy?
Oh, absolutely. I mean, basically what you have is you have a giant financial cartel that runs the world. You know, we have the U.S. government, the Canadian government, the British government, the French government, German government, whatever government you want to pick. But they're just there for show, for the people to complain about and somebody to elect every 4 years or it's 2 years or whatever the case is. The fact of the matter is that the banking system runs the world, and it's been that way since the Federal Reserve was formed back in 1913 or whatever year that was, and They have an iron grip on just about anything financial, and right now that includes the precious metals.
Should Canada and Britain and other countries that got rid of all their gold reserves start buying gold again?
Absolutely. I was never very happy about the fact that our gold got sold out from under us by Byron Mulroney and after him Jean Chrétien. Our two prime ministers pretty much sold all of that. But the thing is, if Canada and Britain and a lot of other countries that sold their gold back in the 80s or 90s or whenever decided to say, made the announcement, look, we're going to buy all our gold production until we get up to X number of tons of gold, that would blow the gold market wide open, and there's no way that they're ever going to do that. And I think that Britain and Canada are going to remain goldless forever.
Is that a big mistake?
Oh, of course. The fact of the matter is, all you have to do is look at what Russia and China and Turkey and India and all these places out there that are buying up gold as quickly as they can. Of course, India is a different case because the people are buying it, not their governments. But the fact that Russia is buying it and China is buying it and the United States is supposedly sitting on 8,000 plus tons of the stuff means that, if they're doing it, certainly Britain should be doing it, and Canada should be doing it, and Australia, New Zealand, every other Western country out there, because Europe's sitting on 8,400 or 9,000 tons of gold? And why should countries like Canada and Britain and Australia, other countries in the Western world, not have gold reserves as well? No, it's a huge mistake, and they're going to pay for it at some point.
Is the gold-silver ratio turning bullish for silver?
No, it's still, I hate to use the word butt-ass ugly. It's around 80 to 1, and it's been that way for years and years and years. Of course, that changed back in 2011 when silver price was climbing sky high. But the normal ratio should be far, far less than that. And let's just say, what does it come out of I think Keith Neumeyer told me they mine 9 ounces of silver for every ounce of gold. So 9 to 1 ratio, that's about 8 times. So just based on the ratio, silver should be 8 times what it is today, and just off the back of the envelope calculation, that's about $120 US. And of course, it'll reach that price, but the ratio won't be the same because gold will be going up as well. But even on a 30 to 1 ratio, silver should be 3 or 4 times the price it is today, and it's only because of J.P. Morgan Chase and the other bullion banks that it has never been allowed to get to that level.
How is the HUI, the Gold Bugs Index, doing?
Well, lousy. I mean, the Huey's doing lousy. The silver stocks are doing lousy. Sentiment's terrible. Was it some mutual? Was it Vanguard? I think it was Vanguard or something. Just announced that they were merging their precious metal fund with some other fund and sold a huge chunk of their gold position, which is one of the reasons why the Huey and the silver stocks have been doing so poorly over the last 2 weeks or 3 weeks, is because they unloaded a bunch of positions into the market. But sentiment is as bad as it could possibly be. And like I said before, when sentiment sucks like this is the time you should be putting your money down. And if people have some money to put down, I recommend that they seriously think about doing it in the not-too-distant future.
Is the XAU doing the same thing?
Exactly. The big miners actually are doing worse than the small miners. They're just flat running out of reserves, and there's no reserves. There's nobody to buy that makes sense to them, and their basic production profiles are going down year after year. The peak gold argument's been around for 2 or 3 years now, and say what they want. We're either at peak gold, right now and heading down the slippery slope. And the thing is that there's no way that that's going to change no matter what the price of gold is going forward. As a matter of fact, if we see a huge increase in price of gold, let's say just for fun, $1,500 or $2,000, get back to our old highs of $2,000 an ounce, I absolutely guarantee you that gold and silver production will plunge, and that's because what will happen is that the miners, the geologists go in there and they'll change the mine plans to get the maximum amount of gold they can get out of their mines. And I can tell you right now that would mean mining less gold and less silver, which will even exacerbate the situation even more. So one of these days we're going to see that happen.
Ed, how can people find out more about your company?
Well, they can just Google my name, Ed Steer, S-T-E-E-R. It's Ed Steer's Gold Silver Digest TSX.com, or just like I said, Google my name and my website will pop up, and they can read my trials. I have a sample subscription there, a sample column, and they can read that. And if they're interested in what I write, they can sign up, and the freight is $100 US per year.
Ed, thanks for being on This Week in Money.
Thanks for having me, Jim.
My guest has been Ed Steer, founder of EdSteerGoldandSilver.com. He's also a director of GATA, the Gold Antitrust Action Committee. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Wolf Richter, and Ed Steer. And thank you for listening. If you have any questions for the show, you can send them to info@howstreet.com. I'm Jim Goddard. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Jim, it's the long weekend coming up, so I'd like to, say that I always enjoy our discussions.
The markets were pretty rough at the start of the week, and of course, led by Facebook and its huge loss in value, and then Twitter, the same thing. Did that kind of sidewash hit everybody?
Jim, that certainly reflected on the entire market. It certainly reflected on the venture exchange. A lot of stocks lost ground, including us, and it looks like we're coming back up again. And if you look at the chart for the last 2 years on AMI, you'll see that this is a mirror image in the last year is a mirror image of the year before. And, the same timing, everything else, which, brings to mind maybe month ends for the brokerage firms. But regardless of that, the markets have been weak, but I've been saying that we can expect a better market. And I think we're going to see it starting this month, and we're going to have a good fall. And certainly all of our news has been not just encouraging, but very positive. And, so you wonder why the stock would go down when all the news is good, but that's, you get caught in the stream, and that's what happens. And, you just have to work your way through it. And just the best thing that you got working for you is knowing that you have a very good product and that this is going to be temporary.
With China's move to make their entire fleet of vehicles electric in just a few years, what does that mean for a company like yours?
Oh, that means a tremendous amount of EV batteries there over the next few years. We'll be reaching the end of life. It's good for the company. Recycling the material certainly alleviates the strain on mining cobalt and lithium, for that matter. And so that's all good news for us. Certainly, China's talking about recycling, and they're looking for recycling solutions. And I've been saying on our discussions over the past couple of months that we've been getting more attention out of Asia than we do out of anywhere else. We do get attention out of the U.S. and Europe, but it's predominantly Asia. And now, with the latest news about recycling and what the EV cars have to do about recycling is telling me that some of the battery manufacturers in Asia are definitely looking for a solution, looking for a recycling solution. So that's got to be very good for us. The tone was great for recycling a few months ago, then it went into reuse, and now I see it's picking up on the recycling front again. And that is, again, good news for us because, we've been saying for a long time there's a lot of batteries reaching the end of life, that if we were in production today, we would have a steady, feed. I don't know how many tons a day that feed would be, but we'd have a definite feedstock for recycling, and that's only going to increase as time goes by. So that's good news for us, Jim, and we've been working, Cametco's been working away on the bench scale on disassembly and recovery from the disassembly process. And we'll be talking more about that once we press release some stuff. So it's all coming together, and we just see that this is a great opportunity for the company. So, and I do believe that the Australians will be working on our project in the next few weeks up at Hazelton. That's the high-grade gold and gold, copper, and cobalt property that we have there. So there's going to be some, hopefully some news coming off of that. And so it looks like they're coming through the summer. It's been a very hot one. And now it's cooled down for the weekend, which I think is good. I just hope there's not a lot of fires that screw up camping for people. But it's certainly definitely cooled down and makes it's an easier environment to work in. So I don't, other than this market reaction that we've had, which has got everybody's attention, and of course Apple reaching a $1 trillion market cap is just fantastic. I mean, it's the only company in the world that has that, and that's very close to what we do. Apple uses about $300 or $400 million worth of cathode material a year for their handheld and tablets and all those types of their iPhones, all those types of applications that can be recycled. So that's a yearly recycling situation that's worth $300 to $400 million a year, and certainly would help Apple with their problems with people, criticizing the fact that they've been perhaps using some of the stuff out of the DRC that involves child labor, and whether that's true or not, I don't know, but we're hoping that our process would alleviate that for companies like Apple, and I'm sure it will. And so I'm optimistic, Jim. I'm optimistic that we are moving in the right direction. I'm optimistic that things are coming together as they should. We're meeting expectations. And I'd just like to take this opportunity to wish our shareholders a great long weekend. It's a long weekend that I'm looking forward to, and I'm certain a lot of people out there are looking forward to it.
Larry, where are you traded, and how can people find out more information about American Manganese?
We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2M. And you can reach us at AmericanManganeseInc.com, or you can phone at 778-574-4444, or you can email me at LREAUGH@AMYMN.com.
I've been speaking with Larry Reaugh, President and CEO of American Manganese. I'm Jim Goddard. Our conversation took place on August 3rd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.